Looking for trusted vehicle protection? American Guardian Warranty Services has you covered. Since 1998, we've delivered top-tier coverage, award-winning support, and industry-leading training to keep your business moving forward. Every way forward.
Welcome to Daily Drive for Thursday, July 24th, 2025. I'm Jake Neer in Detroit, in for Kellen Walker. Today on the show, Tesla's earnings fall further in the second quarter. Hyundai warns of growing costs from U.S. tariffs in the second half, and steel, aluminum, and copper prices are on the rise amid import taxes. Plus, car buyers will get a tax deduction from their auto loan payments. Our own Paige Hodder talks about what it will mean for the overall retail market.
It's certainly a bright spot in what has been a pretty dreary affordability market. There hasn't been a lot of good news on the affordability side.
Let's run through all the news you need to know to keep up in the auto industry. Tesla's second quarter net income fell 16% from a year earlier to $1.2 billion. That's amid a deepening sales slump and rising discounts to move its aging electric models. CEO Elon Musk said on Tesla's earnings call on Wednesday that the company is in a strange period where U.S. federal incentives are going away at the same time that autonomous driving is still in an early stage.
I mean, does that mean we could have a few rough quarters? Yeah, we probably could have a few rough quarters. I'm not saying we will, but we could.
Musk also said Tesla's delayed, more affordable model, launching in the fourth quarter, is essentially a cheaper version of the Model Y crossover. Musk didn't offer other details such as the price or specifications. Hyundai says second quarter operating profit fell as U.S. tariffs on vehicles and parts started to weigh on its bottom line. The Korean automaker warns of a bigger impact in the current quarter. Hyundai booked operating profit of 3.6 trillion won in the quarter, or about $2.6 billion. That's down 16% from about 4.3 trillion won in the same period a year earlier. The automaker said U.S. tariffs cost the company the equivalent of $606 million in the second quarter. And some of the growing tariff costs in the current quarter is likely to come from metals facing higher import duties. Domestic producers of steel and aluminum have raised their prices since President Donald Trump's metal tariffs went into effect earlier this year. Steel Dynamics says it sold steel in the second quarter for an average price of more than $1,100 per ton, 14% higher than in the first quarter. Cleveland Cliffs said the average price of its steel stood at $1,015 per ton, up 3.4% from the previous quarter. Analysts say those increases track with the rest of the steel market. And those are today's headlines. And joining us now to talk a little more about Tesla's earnings call is Lawrence Iliff, who covers Tesla and a number of other companies for us here at Automotive News. Lonnie, welcome back to Daily Drive.
It's great to be here.
Well, this was an interesting one. I don't think that the top line headline was all that surprising that Tesla would see another sort of slide in their earnings, but there was a lot to unpack in terms of their future plans and sort of their products. What struck you as sort of the big takeaway from the call itself?
I think what struck me most is kind of them being more explicit about the fact that not only are they, transitioning from EV maker to robo-taxi company, but that it's going to be difficult along the way, right? Mm-hmm. They've kind of hinted at that in other calls and stuff, but we're still selling a lot of cars and energy is doing great. And, they're kind of papering over, I think, an obvious difficulty, right? That their EV sales are going down fast, right? Down 13% in the first quarter. Down 13% in the second quarter. They're having to put more money on the hood. Their net profits going down. They even a little bit of their cash went down. And it's like, there's some, yellow, red flags out there. And they kind of acknowledge them. They said, we may have a rough few quarters as we make this transition. We lose EV tax credits on top of the lower sales, right? And there's some other regulatory money they lose, emissions credits. And so they kind of acknowledge that there's going to be a difficult transition from going to a primarily an EV maker to robo-taxis, and then robots.
Yeah, I mean, some close Tesla followers that I saw online were saying this earnings call is sort of big because it's one of the sort of defining moments in that transition of Tesla becoming more of a robotics and software company. But I believe an analyst asked Elon Musk during the call, these other parts of the business that you're kind of transitioning away from have been essential for financing all these other things that you want to do, and those are weakening. It seems like that is a sort of a tough place to be at this moment in time for Tesla.
That was a really interesting question. I'm glad you brought it up because basically he said, how does an automaker finance an AI company?
Mm-hmm.
Because if you look at the AI companies out there, they're, chewing through, it could be $1 billion a month or more. We don't know, a lot of them are private, but they're just chewing through massive, and they talk about, spending $50 billion on a data center and, these massive numbers. Tesla is an automaker with automaker margins now, right? Financing that. And they said, they can do debt financing and stuff like that. But it's a really interesting question because I think that part of the EV business is falling faster than they expected because of Trump, because of the, loss of regulatory credits, for a lot of reasons. And so they have to be more explicit about it. But it's really interesting because there was also, I saw a lot of criticism that they didn't say how they were going to do the robotaxi transition, right? They have, as far as we know, 10 cars doing a pilot program in Austin, Texas with a safety driver, with basically no revenue because they're basically giving the rides away. It's a test. And Elon Musk says, by the end of the year, we could be covering half of the U.S. population with robotaxis. And people are like, what? I mean, that's not exponential growth. That's hard to believe is what it is. And so I thought that was unusual. And I think we're seeing, the stock price fell 9-10% today. And I think people are like, wondering, they want more information about how this transition is going to happen.
Yeah. And speaking of the auto business for Tesla, one of the things that a lot of people have been waiting for is, okay, you've been talking about this cheaper model because affordability is such a huge issue, not just for Tesla, but for the whole auto market right now. We haven't seen what you're going to do there. And now Elon Musk is basically saying, well, it's going to be some form of the Model Y. Here's part of what he was saying about the Model Y and demand for that car.
The desire to buy the car is very high. Just people don't have enough money in their bank account to buy it. Literally, that is the issue.
So Lonnie, what is he signaling here? Is he signaling a price reduction for the Model Y? Is he talking about a cheaper version of the Model Y, just waiting out unfavorable economic conditions? What should we make of that?
Yeah, I mean, if you go back a little bit in history, right, years ago, they started talking about making a really, really inexpensive EV for the masses. And they were going to build plants all over the world and mass produce this super cheap EV. And that was their business model. Well, that's gone, right? And so kind of product, it's really interesting because if you look at Tesla as an auto company, they don't talk about product. They don't, jazz up product. That's what all automotive companies, we got this coming, we got that coming. It's going to be great. And now, kind of on this call, along the lines of what we've been talking about, it's just very subdued, like, oh yeah, also we're going to make this low cost car. It's going to be basically a stripped down Model Y. They didn't use those words, but kind of. And it was just like, it was so deflating, I think, if you're a car person. And basically, Musk has kind of hinted about how hard it is to take cost out of producing a vehicle, right? And he's used, I think, the 30% number. So I think that's what they're doing. Maybe they're getting rid of the sunroof. Maybe they're getting rid of the power seats. Maybe they're getting rid of the vegan leather, cooled seats, heated seats, lower quality stereo. I don't know, maybe steel rims. But it's also in the third quarter, they're going to keep making just the current Model Y with the $7,500. And in the fourth quarter, they're going to make the cheaper Model Y in addition, but they're not going to have the $7,500. So it's going to be like a double letdown. Not only are you getting a stripped car, you're not getting the $7,500. So basically, let's say for the same amount of money, you're getting a stripped down Model Y. It's, it's unusual.
Yeah, well, it's going to be an interesting transition to see where things go for Tesla going forward, and we know you'll be all over it, Lonnie. Thank you so much for joining us here on Daily Drive.
Great to be here.
Coming up, our own Paige Hodder joins the show to talk about a new tax deduction for auto loan borrowers and what it means for dealers. That's next on Daily Drive.
When it comes to vehicle protection, American Guardian Warranty Services has you covered. Since 1998, AGWS has been a trusted leader in F&I solutions, offering top-tier protection plans for autos, RVs, power sports, marine, and more, all backed by A-rated insurance carriers for reliable coverage you can count on. But we don't just offer protection, we deliver results. With award-winning marketing materials, expert dealer training through AGWS University, and exceptional customer service, we are committed to helping your business grow while keeping your customers protected. Join thousands of satisfied dealers and agents who trust AGWS for comprehensive coverage and unmatched support. Visit agws.com or call 800-579-2233 today to keep your business moving forward. Every way forward.
Welcome back to Daily Drive. I'm Jake Neer. The tax and spending bill signed by President Trump this month gives some car buyers a new break, but trying to figure out who's eligible and what the impact will be on retailers isn't straightforward. Paige Hodder covers retail, finance, and insurance for us at Automotive News, and she's been looking into all of it. She joins me now to talk about her reporting from her home office in Ann Arbor. Paige Hodder, welcome back to Daily Drive.
Hi, thanks for having me.
So remind listeners, what is this break that some people can get? We'll talk about who's eligible in a second, but what is the tax break? How did this come about?
So it came about in the tax and spending bill, the budget bill, the big, beautiful bill recently signed by President Trump. And it is a tax deduction. So it is for the 2025 through 2028 tax years. And when you're filing your taxes, if you bought a car in one of those years, it's essentially designed to give you a break for some of the interest you paid on a car loan. So if you paid cash, not eligible. If you bought a lease, not eligible. If you got a loan from your dad, not eligible. It's a loan from a bank or a loan from, another financial institution, etc. And so essentially, borrowers can deduct up to $10,000 in interest. And that's a yearly thing. So if you bought in 2025, you could do that again the next year. Of course, the amount will change depending on, because the amount you're paying interest on a loan will change, and a complicated schedule, of course, but that's essentially what this new potential tax break is.
So you already talked a little bit about the eligibility, but which buyers are most likely, what kinds of buyers are most likely to benefit from something like this?
So there's an income threshold. It's really, so the cap is $10,000, but the amount you can deduct is calculated based on your income. And there is also an income threshold. So if you make over $100,000, the amount that you can deduct starts to go down. So every $1,000 you make over $100,000. So say you make $101,000. The cap is not $10,000. The cap is $9,800. So it goes down by $200 for every $1,000 you make over $100,000. I hope that made sense to everyone. So it's most likely to be used by, young people in their first job, getting their first or maybe their second car, maybe their first new car, moving out of a used car. Or maybe that threshold is also, it's $200,000 for joint filers. So, if you're married, it goes up. And so maybe a young family looking for, a family vehicle. But one important thing to note is that they calculate your income not using your typical adjusted gross income, but it's the modified adjusted gross income. which is a tax figure that what the experts told me, most people don't know about themselves. It's kind of opaque. They essentially add some stuff back. So whatever your adjusted gross income is, your modified is likely to be higher because they add a couple things back in. And essentially what I heard from the experts is that it's basically unheard of for the everyday person to know what their modified adjusted gross income is. So that's something that would have to be determined at the time of your taxes, maybe with an Excel or maybe with some software or XYZ, but you're going to have like a tax person tell you whether that you qualify under that number.
That's an important point because you spoke with some folks for the story who talked about how dealers and salespeople in stores should talk about this and how not maybe to talk about this as well. Is that sort of a fuzzy area here that people should be keeping in mind that, this is important for retailers to know about, but it might be important for buyers to consult with someone outside the dealership first?
It's definitely a fine line to walk. So one important part about the deduction is it can only be applied to vehicles that were assembled, final assembly in the US. So dealers can certainly talk about that. They can know that part. And that's especially something, important to keep straight because certain models are assembled in different locations and they will likely ask for a VIN number, when it comes time to the taxes. So it doesn't matter if like most of the Silverados are made in the US. It only matters if yours, the one that you drove home with, was assembled in the US. And so that's certainly something a dealership can talk about and like determine. But for various reasons, it's really complicated to tell who is eligible and how much they would be eligible for. So, it's certainly something a dealership could flag, like, this is a thing that you could look into. But the experts I spoke to, the lawyers I spoke to, really said, like, you should not be giving tax advice. Maybe someone's eligible one year, but then they get a raise or, some inheritance. Maybe their income changes. Maybe their situation changes. Maybe they pay off some of their loans. So like the interest changes. All of that is like really complicated. And, dealers are certainly not equipped. Salespeople are certainly not equipped at the desk with minimal knowledge about this customer to, make any claims about the type of savings that people can get. And so that is the fine line to walk, which I'm sure, most, sales and F&I people know. Like, we can't be giving tax advice if we're not a CPA. And let's leave it to the people who know what they're doing to give that advice. But there are certain things to be aware of. And, it's definitely going to change how the market plays out. So, you can start having those conversations, but beware of the lines.
That was exactly my next question is, what will the likely impact be on the overall sales market, which has been very much in flux, for several months now?
Yeah, so I spoke with an analyst and they compiled a list. I include a couple of these in my story of vehicles that are likely to see a boost in sales because of this. So they're, lower to maybe mid-tier, like cost vehicles, smaller cars, who are often bought by people in the income threshold that are eligible for this. So, there might be someone out there who makes less than $100,000, who's going to go into a lot of debt to buy a nice car and then get this break. I don't know that that's a wise decision, but, it seems likely that the people who are out there buying, the Mercedes-Benzes are not eligible. They probably make a bit too much money to qualify for this. But, it's those like lower cost models popular among, young buyers, young families, that type of stuff that are assembled in the US. So, a couple they called out were the Ford Bronco and Escape made in Wayne, Michigan and Louisville, Kentucky, or the lower trim Cadillac CT4 and CT5 made in Lansing. So that kind of stuff is likely to see, a little bit of a boost.
And what about the auto retail market, generally speaking? Do you have a sense of, what the overall impact is expected to be?
Yeah, cars are expensive. Interest rates aren't low. There is severe affordability challenges for a lot of people. A lot of those, especially like, mid to lower income people who are maybe wary about getting into a new car. And so this could be, a game changer for some of those people. One report we looked at estimated that the average savings will be about, 300 something a year, which is not $10,000 certainly, but that could be one monthly payment that you're knocking off, or depending on how much you take out too. And, of course, average new vehicle monthly payments are much higher than that, but you never know. Or, even if it cuts one monthly payment in half, like that could be a game changer for some people. Or it could just encourage some people who are on that edge of, do I go used? Do I go new? To decide to commit to a new car. And, it's certainly a bright spot in what has been a pretty dreary affordability market. There hasn't been a lot of good news on the affordability side. Certainly, it feels like, hey, we're starting to get some interest rate relief, and then boom, tariffs. And, it's just one thing after another. And so this is, one thing that could take down the cost, which there's not a lot of those things these days. So, it's definitely a much needed break.
I mean, if I could get my car payment taken care of for 1 month, I would absolutely take that. It would help out quite a bit. So, Paige Hodder covers retail, finance, and insurance for us here at Automotive News. Paige, thank you so much. Really appreciate this explainer.
Thanks for having me back.
That's Daily Drive for today. I'm Jake Neer, in for Kellen Walker. Thanks to Automotive News journalists Lawrence Iliff and John Irwin for their reporting for today's podcast. You can get the latest news on retail, finance, and insurance, earnings results, and everything happening in the auto industry at autonews.com. We'd love to hear from you. Let us know what you think of the show and the topics we covered today. Send us an email at dailydrive@autonews.com or leave us a voicemail at 313-444-2774. And if you enjoy the podcast, remember to like, leave a review, and subscribe so you never miss an episode.